Welcome everybody to the next video of this Forex program. If you're new here, my name is Will. I am a foreign exchange market trader. And if this is the first video you're watching, please go back and watch the first videos in the program before you watch this video. Even if you are experienced, because I guarantee that you will learn at least one thing. So with that being said, let's get straight into the next lesson and keep this ball rolling. Fundamentals, such an important topic in your overall trading strategy, methodology, and just being able to understand where price is going and why it's going there. That's so important, because if you just trade technical analysis, you're missing out on the big picture. You're missing out on the understanding on where price is going and why it's going there. For me, I use fundamental analysis because I'm able to understand where price is going, when and why. And then that way I already have a directional bias before I even jump on the charts to do my technical analysis. And I just use technical analysis to pinpoint an entry. It's mainly used for timing, risk management, and obviously exiting your position. So it's being able to identify whether or not that fundamental analysis has priced in on that asset just yet, because there's been plenty of times that I've posted fundamental analyses into my Discord community. I've been bearish on the United States dollar, for example, and it hasn't been until days later that that bearish effect have actually priced in and affected that asset. So I think it's really crucial and it's super important for you guys to get at least a basic understanding of this. That way that, you can really take your trading to the next step. So let's look at some of the 7 pillars of different economic indicators that you look at when you're doing your fundamental analysis. Now, all of these that you can see on the screen right now, I don't look at all of these economic indicators, but we're going to get into this now anyway. So macroeconomic data, these are some of the economic indicators that I look at. So GDP, which is gross domestic product, inflation, employment data, retail sales, manufacturing and services PMIs. Now, all of those, I think what I might do is in this program, keep fundamental analysis quite basic, so you have a general understanding, so I don't hit you really hard at once. And in the second program that I dive into a little bit more that's strategy focused, I will dive into each of these economic indicators individually in more depth. That way, you're taking one thing at a time, if that makes sense. So number 2 is central bank policy. So interest rates, quantitative easing and tightening, mainly the forecast. Speeches and meeting minutes, more geopolitical. And number 3, market sentiment. So you'll actually be really surprised on how the stock market and indices and bond yields have a direct effect on the exchange rate of an economy and an asset. Equity performance, bond yields, volatility measures are some more factors that you look at when you're doing your fundamental analysis. 4 is geopolitics, elections, policy changes, conflicts, trade agreements. 5, capital flows, so foreign investment, portfolio flows, currency account balance, trade balance. We touched on trade balance in previous videos, so you have a bit of an understanding on what that is. If you don't understand it or you've skipped to this video, go back in previous videos and watch it. Number 6 is commodity influence, so oil, gold, iron ore, other key exports, and also those are safe havens. So typically when the United States dollar it's uncertain, or there's uncertainty in the economy as a whole, and maybe the economy isn't doing so well, investors typically tend to reallocate their funds, their capital, to safe havens like commodities like gold, oil, iron ore, etc., copper as well. And that way, also at the same time, when interest rates are low, they don't make as much money on their investments when interest rates are low. Whereas interest rates are high, they make much more money when they're invested into bonds. Now 7, market expectations, forecasts, surprise indices, future rate projections, and probability models. So look, if you want to screenshot this, pause it, You can research each of these topics individually now if you want to have a little bit more understanding. That's something that I would have done if, I was watching this and I had only just started trading. I would be researching all of these things. I remember when I first started watching a program that was actually worthwhile, and any term that I didn't understand, I would research it. I would search up definitions. What is it? How does it work? What does that mean? How does it influence me in my trading? How is it useful for me? How can I use it? All of those things, all of those questions I would be popping up into my head, and I'd want answers for them. So look, like I said, I am going to touch on this in future videos, potentially in a completely new program. But for now, if you want to be proactive, go ahead and research these topics. What are differentials? So differentials, there's actually an entire strategy that you can have around differentials alone. But what I'm going to get into now is just the definition. So differentials in the foreign exchange market refer to the differences between the economic indicators of two countries that can impact the relative value of their currencies. These differentials can influence traders' decisions and the overall movement of exchange rates. So some of the economic indicators that have these differentials is interest rates, inflation rates, GDP, so gross domestic product, and surveys. And I did touch in previous videos, I was talking about forecasting and how that has an effect on the exchange rate of a certain asset, and as well as the actual outcome of the release. So these economic indicators here, usually you get more of a effect and reaction from the forecast rather than the actual release. But it really depends on, as well, the circumstances. Alrighty, so surveys. The ISM, the Institute of Supply Management. What is the ISM and how does it behave? Now, the ISM manufacturing ROB or /PMI is one of the most important leading indicators. Again, it's not lagging, it's leading indicators in the world of professional traders and portfolio managers. This is because historically, the ISM has predicted USD gross domestic product within a 12-month time lag with 85% accuracy. Just let that sink in for a moment. Most people that just trade technical analysis don't know this, and this is what you're missing out on. Now, the United States GDP drives global GDP, therefore using the ISM as a guide is crucial for overall medium to longer term fundamental currency direction. So again, like if you're in a position for 1 to 3 months, then you need to be looking at this economic indicator. Even if you're scalping, you're trading on longer time frames, it's still crucial to look at an economic indicator like this because you have that overall direction. Now, most of my fundamental analyses, I'm either bearish or bullish for short term, mid term, long term. Could be up to 3 months or 6 months. Even if I'm bearish for 6 months on that asset, I still, and just say I'm scalping on the lower time frames, I still use that fundamental analysis in my overall directional bias because I want to be able to spot when price is retracing. And I want to catch those short positions in that entire move, if that makes sense. So it's just being able to capitalize on where price is going and how long price is going to be moving for. But that's, again, like technical analysis is so useful because it helps you with timing. It helps you with gaining that indication that, oh, price is reversing now. We're not continuing in this bearish momentum that this bearish fundamental analysis actually presented us. But that's why you always keep up to date with fundamental analysis because it can change depending on an economic release or an event or what a speech. So many things can change and really put a spanner in the works in your overall fundamental analysis and bias. So it's really useful to at least have a basic understanding of what this stuff is. Now, USD GDP drives global GDP, therefore using the ISM as a guide is crucial for blah, blah, blah. We already talked about that. Right. ISM growth equals positive for the US economy. whereas contracting ISM, potentially negative for the US economy. ISM growing, then slowing, equals gross for the US economy, but not as good as originally predicted. It is contracting, but the contraction is less than the previous period. It's still negative, but overall the ISM is improving. I hope that sort of makes sense. It's very, I think, clear in the wording as to what that means. So when you're looking at the actual value, so whether it's under 50, over 50, at 50, if the previous release was 47, now it's 48. Obviously that is good for the ISM. It's still bad, but it's improving. So you can sort of put the two and two together. Now, this is an example of the ISM PMI, and it measures business activity and production, new orders, employment, prices. It also displays exports and imports and supply chain indications. So obviously we talked about under 50 is contraction, over 50 is expansion. And it really tells us if the economy is growing or shrinking at the business level before GDP or jobs data shows us. So you're essentially getting a understanding of where the economy is at overall, health-wise, before everything else comes out. That makes sense. You're essentially getting an indication ahead of time. That's why it's a leading indicator. Now, let's talk about how to actually read this. So as you can see at the top here, we have services PMI and manufacturing PMI. So the left side is services PMI, which covers finance, retail, hospitality, healthcare, transport, etc., etc. You can see some of these categories at the bottom here in different numbers. Have a look through this as well. But on the right side is manufacturing. So it covers factories, production, goods, and industrial output as well, which also have different outputs. And then obviously we can see at the bottom, overall economy and services sector growing from contracting, 1-1. And this is the month over month release. And in this section here where we can see direction, we can see that this table already shows us whether or not it's growing faster, it's contracting, increasing, or it's too high. So obviously down here we can see too high, it's 64.1. And we can see the month over month change from previous releases. You can see plus 2.6%, which equals growing, plus 4.9% is growing, etc., etc. Contracting, increasing. As you can see, you sort of get a pretty good understanding on where the economy is at overall just from this table alone. But it's pretty easy to read. But what we can tell from this table is that the services PMI is growing. Manufacturing PMI is not growing. It's getting worse because the previous release was 48.6, now down to 45.8. And remember, over 50 is good, it's expanding. Under 50 is contracting, not so good. So what that tells us is the manufacturing side is not good, but it could mean a lot of different things. So tariffs could be high interest rates, weak global trade, slower China/Europe trade agreements. But essentially it means the economy isn't collapsing. It's pretty much like rotating. It's going from manufacturing to services and goods and services. So what we can get from the end result of looking at this survey is that PMI is mildly bullish for the economy. It's pretty much like in a soft landing stage where we're not in a boom, but we're also not shitting it ourselves essentially. So we're slowly growing, if that makes sense. So it's more on the bullish side than the bearish side, which means that is one positive indicator for USD. And there's so much more that goes into this, especially on Excel with data and scorecarding. But what we're going to talk about now is how you need to essentially do an analysis like that, but on every single economic indicator. And then you're going to have a mixture of bearish economic indicators and bullish economic indicators, and you need to tie them all together to get an overall perspective on whether you're bullish or bearish for that asset, USD. Alrighty, so collecting ISM data, where do you get it from? So the ISM releases its Purchasing Managers Index, PMI, on the first business day of each month. You can go to this link here, screenshot this, copy the link, whatever you want to do. Go to that link and you will be able to essentially download it. You can either download it to Excel, it gives you a few options there, or you can just view it straight from the website. Members of the ISM Business Survey Committee receive a questionnaire each month that asks them to identify month-over-month changes for each index. It's a survey that asks the largest 300 US manufacturing companies in the US questions relating to their business activity in the previous month, covering 5 areas with equal weighting. So the ISM Manufacturing Report of Business, ROB/Purchasing Managers Index, is significant because it represents 20% of business contribution to GDP in the United States. It reflects real goods bought and sold in the US economy. So 20% doesn't sound like much, but of the entire economy, that's a lot. Data for the ISM manufacturing goes as far back as 1947, whereas services data only goes back to 2008. As there is more historical data, there are higher confidence levels in correlations. So I hope you understand ISM, what it does, how it influences the economy, and how important it is to understand it. I know I'm sort of speeding through all of these topics, but there's just so much to cover that if I stop and explain everything for hours on end, then you guys aren't going to watch future videos. But again, I'm open to feedback. So in the comments below, if you do want me to slow down, if you want me to elaborate on any more topics individually, then let me know and I can make future videos. I can even just add it to this program. All right. So I don't have to wait until a future program release to be able to make additional videos on certain topics. Now let's get into catalysts. Catalysts are huge as well. And there's a few strategies on actually profiting from major market releases like catalysts. So a market catalyst is an event that causes a form of reaction, impacting price either positively or negatively. You guys are pretty familiar with catalysts. Everyone goes on about it, like the only sort of form of fundamentals that's ever implemented into people's trading methodology, but as forex factory is as far as it goes. So these catalysts often shift market sentiment, leading to increased buying or selling activity, depending on the forecast, the data, and the release, obviously. So although catalysts are often events or news, not every event or news could be considered a catalyst. If a political event has no impact on the strength of a nation's currency, that event will most likely not get priced into the currency and there will be no catalyst or reaction. There are a few catalysts that you'll see on Forex Factory or even TradingView that have little to no impact on the asset. You're like, oh, there's this major news event, nothing's happened. Well, it's not much of a catalyst. But again, despite this, doesn't mean you should not ignore it. You should definitely manage any positions that you're in accordingly, depending on how close you are to that catalyst. These are fundamental to understanding how markets move in the long term. So different types of catalysts are inflation rate changes, the releases, central bank actions, geopolitical events, and I will say inflation rate changes if it's completely different to the forecast. That's usually when you find a huge move. If it's pretty much spot on to the forecast, then you have a pretty good understanding of where price is going to go. And sometimes it doesn't have really any reaction. Geopolitical events, global events, trade balance changes, which we talked about in previous videos, credit ratings updates, natural disasters is a big one, and pandemics, obviously. So everyone can go back and backtest the 2020 coronavirus period where every economy took a big hit. Now, why are catalysts important? Well, staying well informed about potential catalysts is obviously super important for you guys and investors, long-term investors, as these factors have the potential to significantly influence the asset that you're trading. So these events, although they have the potential to greatly increase profit, they also have the potential to completely wipe out your positions. Some people could even get margin called if they're not managing risk correctly. Conducting a catalyst appraisal or an assessment of upcoming catalysts will allow you to understand the upcoming risks to your trade. This is what I've been talking about in future videos and even in this video as well. Having that even basic understanding of what is coming up, what it is, what the forecast is, and your overall understanding of that catalyst is so important. So I think everyone should, even at a basic level, do a little bit of research on that upcoming catalyst. For a lot of FX traders, events such as NFP, release, or CPI updates often see immediate and volatile price action on release. Maintaining awareness of these events and doing the work prior to potentially forecast the actual results, which is what we've been talking about, can give you an edge not many retail traders have. So again, it's not just managing risk, but you can actually use that analysis to profit from a position. Yes. So if you're already bearish and you want to be taking a sell, just say you get into a sell position an hour before the upcoming catalyst or half an hour before, you're managing risk, you're 10 minutes away from the catalyst, you place your stop loss to break even or even under break even into profit. So you can allow for spreads during that time, depending on how big your position is as well. But if your forecast is that the release is going to be bearish for that catalyst, that's just going to add fuel to your position, which is absolutely awesome. A lot of people just get out of the trade completely. And that's a good idea if you don't have an understanding of the catalyst. But if you do have an understanding of the catalyst, you can capitalize on that opportunity so much more than a trader that has no understanding of it. So this is what really separates professional traders to amateur retail traders. Now, how can you use them as a confluence? We've been talking about it. Let's get into it. By completing a macro analysis leading up to an event, you can prepare for the catalyst and trade accordingly. Now, an analysis of an upcoming catalyst includes thorough research and data scraping to identify common traits within specific events and their historical impact on price. So not just the current catalyst, but also researching and back testing previous catalyst releases. So look at the previous forecast numbers, the actual numbers, and then go into the charts and look at the reaction. You will be able to spot a trend for, if you're just say you're back testing CPI, go back and look at all of the previous releases for that catalyst, also the forecasts. See what reaction it displays, and just say they're all bearish numbers depending on if the forecast and actual are very similar, and then you find one that's had a bullish reaction, find out why that had a bullish reaction that specific time compared to other times, if that makes sense. So just do a bit of back testing. This is the sort of back testing that I like, that I find that's actually useful. As an example, CPI provides an indication on inflation levels over time using household products. So if you were to collect this information yourself by recording these prices of household items you know of from a previous date and comparing them to the price of those items today, you see the inflation for yourself before the CPI figures are released. Let's get into misconceptions versus reality. So some of the misconceptions around catalysts is that catalysts are not profitable to use as a confluence. We've just discussed previously that it can be very profitable if you know what you're doing. Trading a catalyst will make me rich. I honestly, you may as well just go buy a lotto ticket because it's safer. Probably not going to make you rich. The only way to predict a catalyst is through technical analysis or forex factory. Again, what we've previously discussed, it's not the only way. You don't have to just sit on Forex Factory or TradingView to understand these. There's much more to it, essentially. I should avoid trading catalysts. On the commencement of a catalyst, yes. But if you're in a position already, then manage it accordingly. Catalyst reality. Catalysts can be profitable if used correctly, yes. Trading a catalyst can also wipe you out, definitely, absolutely. Catalyst appraisal is a macroeconomic process, not a technical analysis process. So it's not just, obviously going on to TradingView and looking at the reaction of that catalyst. You actually have to look at the data and the sentiment behind it. You don't have to avoid them if you do the work prior. Absolutely. So I think that pretty much covers catalysts in a nutshell. They can be good, they can be bad, but they can be more on the good side if you do the work and you actually research those catalysts and you understand them. So let's look at an example of this. So the AUKUS submarine deal, this is, actually not that long ago. It feels like a long ago now, but it really wasn't. So in Australia, we announced an agreement with the US and the UK to acquire a fleet of up to 8 nuclear powered submarines. If anyone, probably you're going to remember this, but if you don't, we're talking about it now. So the project is expected to cost up to $368 billion by the mid 2050s, with $9 billion in spending allocated for the next 4 years. Now, how does this affect the Australian dollar? When a country's volume of imports are high, which is Australia in this circumstance, it means it will positively affect the exchange rate of that currency. And again, we've spoken about this in previous videos when we were talking about international trade. So you should have a pretty good understanding of this, what I'm talking about. However, the Australian government estimates that the nuclear submarine program will require 20,000 jobs over the next 30 years, spanning the Australian Defence Force, the domestic shipbuilding industry, and the public service. Of these, 8,500 will be directly employed in Australia for the building and services of the submarines. This workforce will include scientists, engineers, project managers, construction workers, electricians, fitters, and builders. Employment levels significantly impact currency exchange rates by influencing economic growth, interest rates, consumer spending, inflation, trade balance, and investor sentiment as well. So high employment typically signals a strong economy, attracting foreign investment and increasing currency demand. And central banks may adjust interest rates based on employment data to control inflation, further affecting currency value. So if inflation's too high, central banks are most likely going to increase interest rates for Australia, which will essentially influence people to spend less because things are going to cost more because interest rates are higher. So people tend to borrow less money as well during those times when interest rates are high. But for foreign investors, that's much more attractive because their yields are much higher on their investments. Additionally, employment levels can affect production and exports, impacting the trade balance and currency strength overall. Positive employment figures boost investor confidence, which just attracts more foreign investment, while wage growth enhances consumer spending and economic growth, all contributing to currency fluctuations. A lot to take in there, but I hope you're understanding this because it's a lot to take in, but it's fucking crucial for you to understand. So let's talk about some homework for you to go away and do yourself. So examine the price action of an asset by reviewing the chart to identify significant price movements of the beginning of new trends. Once you identify these changes, determine and record the catalyst behind them. While not all catalysts influence asset prices, every notable price change is driven by a catalyst, so a significant move. It's essential to identify and keep track of these catalysts. For example, focusing on British CPI announcements is near irrelevant if you're trading AUD/JPY. That's pretty common sense. Although many FX pairs are influenced by similar factors, each pair has unique characteristics that are important to recognize. So consider the common sense aspects of correlations. For instance, a catalyst for the AUD might be related to the commodity sector due to Australia's mining-based economy. If uranium yields rise, uranium exports increase, which boosts the Australian gross domestic product. So I hope you all sort of like tying this in and understanding this now. A stronger GDP leads to an appreciation of the Australian dollar, causing charts for assets quoted against AUD to rise as more of the quote currency is needed to purchase one Australian dollar. Thus, monitoring key export news and reports is crucial for the Australian dollar.
Alrighty, once we're on TradingView, all you want to do, if you haven't already enabled economic events, remember this is all shown on the essential plan. So this will be available to you guys, and I'm using the essential plan because I wanted to show you guys exactly what is available to you. So if I right click on the screen, go to settings, go to events at the bottom, and then click on economic events. That will pop up with all of the economic events available to you. Now you just press OK. And if we go down to the 1 hour time frame, we can see the major market catalysts. So we've got retail sales, which is a red news event. And we can see how this negatively impacted the foreign exchange market. So this large move to the downside was due to this major market catalyst. Now, not all the time does these major market catalysts have moves exactly this size, because this is quite a sizable reaction. So it's a 60 or just under a 60 pip move, or a 0.46% move in the foreign exchange market. And that's quite big, especially when we start going into talking about volatility and average true range. You'll understand how large 0.46% is. And in this example, you can still see those effects in the foreign exchange market. And for scalpers, this is quite significant. And we'll just go through and look at GDP growth, all these GDP growth data releases. We can see core inflation. Again, we can see how, and this is what I was talking about in terms of volatility. So people would be potentially buying in this bullish move to the upside, and just say there's retail traders that haven't put the work in prior, but they've just seen that the forecast was potentially positive and price action is bullish. They've put in their long positions. I am on the hour time frame, so let's just say they've got, for most scalpers, stop losses range around 6 pips, like that. Just say they're targeting the high for about just over a 4-to-1 move. And they're like, oh, yep, I'm going to make money off this. And we can see price did move up in profit, but then it also came back down and completely wiped them out. So though, even if they had a 20 pip stop loss and it was just a 1.3-to-1 risk reward trade, you can see how volatile these catalysts are. And again, with the inflation rates now, so the actual was actually lower than the forecast. So they thought it was going to be positive, but it was less than the forecasted results. So we can see that negative effect on the foreign exchange market here. This is for GBP USD specifically. They'll have different economic events for different currency pairs, but usually if GBP, just say you have a currency pair and they both have the exact same currency in them, so GBP USD and Euro USD, you have to look at the economic event to make sure exactly what event it is. So down here we can see the United States flag, so that would be a United States economic release, and this was a British economics release. So this move here would affect both Euro USD and GBP USD, or also currency pairs like AUD USD as well. We can scroll over to the left and look at all of these different effects that these catalysts have on the foreign exchange market. And we can look at some bigger ones here. Heaps of volatility there. Now this one is absolutely massive. Unemployment rates and non-farm payrolls, these are always usually super big, and we can usually, leading up to an economic event, you do have like a slowdown in price, a lot of consolidation, ranging like we have shown here, and then we have this massive move to the upside. So it was positive for the British pound and negative for the US dollar. And it makes sense because it is a United States economic release. We can see if we measure this is what how useful the measuring tool is. You can see that was almost a 100 pip move. That's a 0.77% move to the upside, which is absolutely massive. So again, another huge data release, another one again. So this British release was positive for GBP, and this was negative for GBP USD. And if you just go through in your own time and look at all of these and how they affect the foreign exchange market, like look how volatile this economic release was, you'll be able to identify different economic releases and their effect. You'll be able to see what economic releases affect the foreign exchange market the most. They're going to be different each and every time. Look, there's PPI. Inflation rates again, and that is just huge, absolutely massive. What do we have here? GDP, the Fed. So another geopolitical event. Unemployment rates, non-farm payroll. See, non-farm payroll didn't have a huge effect this time, but you can go away and look at all of this in your own time anyway. But you can see how these major market catalysts can definitely affect your trades, your live positions, and your overall trade idea generation process, especially if, just say, you have done your technical analysis and you have your trade ideas ready to go, they're in your head, and you haven't looked at these economic data releases, and just say, for example, we're in short-term bullish market structure here and we are looking for buys, but then you haven't done the work and looked at the upcoming data releases and found out that, just say if you did do the work, you could have potentially capitalized from this bearish move to the downside. So there's a lot of opportunity with these major market catalysts, and there's also a lot of risk involved too. So the whole lesson from this video is to make sure that you're aware of any upcoming economic events and major market catalysts.